What if Bitcoin's next all-time high is just weeks away? Despite market turbulence, Bitcoin has quietly gained 29% in the past month, even as traditional markets struggle. While many investors wait for clear signals, smart money is already positioning. In this video, I'm going to show you the real-time indicators and global shifts pointing to an imminent breakout. To understand why Bitcoin is gaining strength so quickly, we need to take a look at what's breaking down across traditional markets. Investor and corporate confidence are eroding faster than the media is willing to admit. Jamie Dimon, CEO of JP Chase, recently said that a recession is now the likely outcome as tariffs and economic uncertainty ripple through the system. American consumers are just as worried. The University of Michigan's latest survey shows that only 12% of Americans expect stocks to rise in the next year, the lowest optimism on record. Unbelievable, right? Foreign investors are already acting. Over the past 2 months, $63 billion has flowed out of US equities. And at the same time, the share of US government debt held by foreign entities has fallen to just 33%, the lowest in 25 years. Ray Dalio recently warned that rising protectionism, growing national debts, and deglobalization are setting the stage for a breakdown of the international money system. When major US holders of US assets begin to exit, it accelerates stress throughout the global financial system. Adding to the pressure, Goldman Sachs now forecasts that the US will post slowest economic growth and the highest inflation rate among developed countries in 2025. Insane stats out there, what people are thinking, guys. Look at what most of the world is thinking right now. And on the surface, it's easy to see why. But as you're about to learn today, all we have to do is dig a little bit to uncover the bullish truth of what's actually happening. So if you're already subscribed to the channel, then you're already way ahead of 8 billion people on the planet when it comes to positioning yourself for a much brighter financial future. And if you're not already subscribed, make sure to hit that subscribe button and turn the bell notifications on and join one of the most educated and prepared audience in the world. And for all of you, if you're excited to find out why most are wrong out there and how by learning this info gives you what you need to be a global macro investor with an edge, then you know what to do, guys. Destroy that like button and let's get into it. So periods of low growth combined with inflation tend to weaken currencies, shrink investment returns, and erode the real value of savings across an economy. There are not disconnected events. There are clear signals that the current systems are becoming less stable by the day. Something serious is brewing beneath the surface of global trade, and it's showing up first in shipping routes. Container ship traffic from China to the US has absolutely plummeted. Over 40% of sailings on major Asia-US routes have been canceled, a rate that typically signals acute disruption. And because ocean freight takes 4 to 6 weeks to reach US ports, we're only now starting to feel the first effects. By May 10th, nearly all inventory arriving on US shores will have been shipped before the latest round of tariffs. After that, restocking slows to a trickle, grinds to nearly a halt. Most Americans won't notice at first until certain products quietly disappear from shelves. Delivery timelines stretch and prices start shift without warning. That's why this moment matters. It isn't just about tariffs. It's about timing of how economic pressure builds. When companies can't replenish supply, they stop hiring. When their margins shrink, they cut spending. It all happens with a delay, and that delay is now running out. At the same time, the US Treasury is borrowing aggressively to cover rising fiscal needs. In just 1 quarter, its projected borrowing soared by 320%, now reaching $514 billion, right as bond markets are signaling unease. The yield premium on US Treasuries just hit an 11-year high, meaning investors are demanding more compensation to take on government debt. Add in slowing job openings and persistently high inflation, and the signs become hard to ignore. This is going past a normal slowdown. It's a slow motion tightening that will start to move fast once the trade effects filter through.